I tested it out this weekend, and I mentioned that I would share with you all the model I'm teaching my son, Caleb. I'm not afraid to teach it to you. I'm not trying to hide it from you. Okay. But I wanted to make sure he had some foundation to what it is he's trying to do. And I wanted to spend time with him and figure out, like, because of his characteristics, what's his concerns, what's his fears, what's his comfort level? Is he trying to, trade the whole daily range, or is he trying to get in and out real quick, small little pieces? That type of personality inquiry that you have to do as a trader too. You don't take a model because you see somebody else doing well with it and say, I'm going to do that. Because if it doesn't match your personality, if it doesn't match the way you see and engage price action, you'll never make it work for you. Okay. So I'm aware of that. I'm cognizant of that effect on individuals learning things, not just this, but anything. But with something so technical as this, in this industry, with as many as we have in terms of variables for choices, what to do, think about all the indicators that are out there. Think about all the trading styles and methodologies and teachers and their respective personalities. So you have to be able to, number one, be able to put up with them and listen to them, to learn from them. And sometimes I'm off-putting. I can't retain the attention of everyone, or they don't like my teaching style, or they don't have any faith in me, or whatever. I'm not going to scratch the itch for everyone, but for those that sit down here and they want to learn from me, obviously you've seen live accounts being utilized this year. My son started trading in the first week of May of this year. He started trading a live account, and he opened up with AMP futures. And I'm not repping them. I'm not saying anything for you to go and open up an account with them. But I have been asked, are they a good broker? I can only report the fact that he has not reported any issues with his fills being executed and done professionally. The only issue there was they weren't happy with the fact that I was sharing one of his statements that he emailed me. And they asked him to ask me to take it down. So I took it down. But I can talk about the numbers. Okay, so here's what he did. He had a equity low of 28.10, and in a matter of a number of weeks until just at present, he didn't do any trades today. Okay, we were observing. I was teaching. I did trades myself, but he was observing. He's in the position of spectating, not speculating today, because I wanted him to understand that the large range day can creep in like it did in the afternoon, and it may not look so clear in the morning, but we were looking at it with that lens, and I was showing that beforehand in the marketplace and in the commentary on Twitter. But he's at 18,300 plus. So in the course of like 4 weeks, that's about 400% return. So that's, in my opinion, that's a remarkable growth. That shows, obviously, he knows what he's looking for. He knows what he wants to do. He wants to obviously grow his account. He wants to build it up and not try to hit grand slam home runs. And because he works at a low-paying job, it's real easy to hit that threshold that he earns on a weekly basis. So when I sat down with him, one of the things I felt was imperative was he has a very short attention span. He's easily distracted. So I wanted to give him a model that gave him a very low threshold for a return of points or pips. And since we settled in on the index futures market for him, it ignores the spread issues that are going to be a plague for traders that are using Forex. It's a professional market. It's a very liquid market, the E-mini S&P. And it's systematic in the way it delivers price. So if I can sit down with him, I want to take him to the chart at a specific time of day with a specific logic in mind, and then have him hopefully see a pattern that repeats, it may not form that day he sits down. Then he has to just move to the sidelines and do nothing. That choice to say, I don't see it today, and then if something forms after the charts get closed, or if the trader moves away from the charts and they come back later on and they see it moved a certain way, that fear of missing out, you need to squash that quickly in the beginning. And the only way you do that is by backtesting and seeing how many times these things form. So while we did that together, because I'm his father and I'm literally next to him, like I'm next to him, giving him my experiences as close as I can possibly be, next to doing it. You know what I mean? Like I'm sitting here acting like the internal voice for him. I'm saying, okay, what do you see here? What do you see there? What happens if you did this? And what happens if you did that? Where would you think price is going to go? So I'm literally being the internal dialogue that 30 years of experience would have spoke to him internally. So he has that inside advantage, okay? That home field advantage, if you will. He's pushing the buttons, obviously, and if he elects to do nothing based on what I'm asking him about in the chart, sometimes the market moves, he's not in it. Sometimes he does something and the market does something against him. And he has that decision of, do I let the stop loss get hit, or do I just bail now and figure out what it is that I did wrong or what I'm uncomfortable about? So it may not be the ideal learning conditions for everyone, but I know where I'm leading him. I need him to be prepared to obviously look for a specific element in price action, and it's algorithmic. Okay, I'm not sitting down with him with anything retail. I'm not filling his head up with, bull flags and bear flags, and when they fail, because I teach my price action students to look for those types of things. I'm not teaching him trend lines. I'm not even bringing any of that stuff in. I'm taking him right to the brass tacks of what it is that the algorithm's going to do, because I only want him to be a one-trick pony. Right now, that's all he needs to be able to feel confident to leave his job. So I said I would teach it. I said I would show it to you. So I'm going to kind of give you the loose framework, what it is that I try to teach him, what he's looking for, those types of elements. But before I get into it, I want to remind the viewers, because this might be the first video you came across with my content. So I want all of you, and to be reminding those of you that have lost this in the conversation throughout these videos, that price is delivered by an algorithm. Okay. There is no buying and selling pressure. That is something that they use as a excuse for what the market does and or doesn't do. And algorithmic theory is based on time and price. Now, time and price, when I wrote this algorithm, coding it leans heavily on the time element. Okay, what does that mean? What time of day? What day of week? What week of month? What month of year? What seasonal influences? So there's several factors I'm encoded in the algorithm that will seek these reoccurring phenomenon that can be capitalized on by those individuals that know what it is that they're hunting. Okay, that little billboard that flashes, oh, hey, it's time for you to engage now. Okay, that signal, that pattern, that setup, that framework, whatever you want to call it, the moment right before you push a button, that's what I'm trying to take his attention into. Okay, I'm taking all the other distractions away, and I want him to go right in and look at that specific element. Price levels are useless until time is considered. Just because it's trading at your favorite price level, this is the reason why support and resistance is a fallacy. There's many instances that anyone can go back in hindsight and say, here is where this line worked and it repelled price up or down. Do it live, consistently. Pick the right level consistently. And that's the problem that retail traders have. I went through that same thing. I couldn't pick the right support and resistance level, even the higher time frame ones, because sometimes you'll have a move where it'll go up, hit a level that would be otherwise viewed as resistance, and then it starts to go down, and then it goes one more time up higher, And then higher high takes my stop. And then I'm afraid to go back in and go short, right? You've all experienced it. I did the same stuff in the 90s. 1992, 1993, 1994, all those types of fearful events of getting stopped out and then abandoning my opinion about what I thought the market was going to do. And instead of saying, okay, the framework's still valid, I just had the entry wrong. Let me go back in with less risk this time, less leverage this time, and see if it pans out. But like most of you and everybody else, those stop out events create fear and anxiety and uncertainty. So that's why time has to be considered first, because the algorithm is going to start working a specific macro. That means a short order of things that it will do as instructions. It's going to seek a specific level, move to a premium, move to a discount, suddenly move or consolidate and wait for another time element in that same trading day or trading week or month. Okay, so that's the reason why I'm teaching you that element of time is crucial. Your inability to know everything that there is to know about time is going to be the area which you will have the largest growth in, but you'll have the initial adversities. When to do this, when to do that. When going through the motions of what it is I'm teaching you, it'll happen for you that you understand why certain things are occurring at a specific time. And I can't articulate it any better than that. It's just a matter of doing it. Sitting with me every week, looking at what is I'm trying to share, taking your attention to a specific price level. Over time, your eyesight, your understanding, the visibility, the perception of price will be dialed in. You'll know what it is I'm doing because you've done it with me for days, weeks, and months. Okay. Time is of no use unless price is at a key PD array. Okay, just because it's time for you to be able to sit in front of the charts doesn't mean anything unless it's at a key PD array. So in other words, blending the two yields astonishing results and the precision that I share with you. I've done a plethora of examples proving precision, proving prognostication, forecasting, objectives, targets, the whole business. Okay. It's not my aim or goal to try to do magic tricks for you. Okay. I don't want to be out here trying to be David Copperfield of the markets and say, here, watch this sleight of hand. And are you amazed by that? Are you amazed? My task is I'm making you a wizard. Okay. I'm teaching you the craft. I'm not up here performing for you. I try to make it as engaging as I can to keep the attention span on those that are very limited and bored easily. I try to get their attention quick with little things that will draw their attention and hopefully keep them engaged long enough for the effects of learning properly to take root. So if you look at this price action that's been staring at you, does anything stand out on this chart? If you're a new student to price action, or if you're a new student to me, a lot of these things that you're looking at here in terms of the price action, all the movements and such, it looks like a foreign language you've never learned how to read. Well, if you're looking at price action like this, it looks like it has no reason for doing what it's doing. It's completely random. And one of the fun things I get to experience as a mentor with the insight that I have, being in a position where I have done a lot of the producing of these things and the authorship of it, I get the benefit and pleasure of watching people get blown away by the incredible detail that this algorithm repeats and follows. If we take all of the noise away from just all this back and forth movement and we add just a little bit of lipstick, suddenly we have a lot more to work with. What's the first element to algorithmic theory? Price or time? Time. So time begins in the morning session for us as a index futures trader at 8:30. That's when the news embargo lifts. That means at 8:30, that's when there's usually a news event or some kind of economic report that comes out at 8:30 New York local time. So that's the reason why I tell you to set your clocks on your TradingView platform here to the local time in New York. This candle right here is the 8:30 candle in New York time. This morning, I outlined how I felt that we would likely see the market move to a liquidity pool, a specific liquidity pool, and it would draw down and attack the sell side. I teach my son to look for setups that are going to target a specific pool of liquidity. It means I have to have a clear idea where the market's likely to go up for buy side or down for sell side. I'm not trading a support and resistance idea. I'm not looking to go to a level to watch it repel away. That's not what I'm doing. That's a fallacy. That's the reason why retail traders drop the ball so many times or blow their accounts and never find consistency, because they're trying to force something that is designed to fail. I don't know why it's so hard for people to acknowledge when they are met with extreme adversities trying to force retail logic to work. Can you make money with retail concepts? Yes. Yes, you can, if you understand how to reprice like I'm teaching it. If you did those types of things without understanding why the market should do what it's doing, why is price booking the way it is? What does that mean? Why is price going to these specific levels at the time it's doing it? There's a logic behind that. And for some that want to say there is no technical science, at some point, when does it stop becoming useful? All of it's useful. Every tiny, minute little fluctuation in these price movements are absolutely controlled, engineered, and premeditated. Either by AI, artificial intelligence, that's the algorithm. It's following the code that's been written for it. Or there are times when manual intervention comes in and they will send price to a specific price level. Sometimes it's going to be abrupt and aggressive, and it may not be fun or pleasurable being a part of that move. Other times it will be exhilarating because you were on the right side. When those moments of intervention occur, that's a manual intervention. That means someone is literally going in and manipulating price to do a specific thing. What would that be like? FOMC, a rate announcement, something to that effect. And the market will reprice aggressively, quickly, to a price that's well outside the scope that would be reasonably expected for that short-term perspective. Big explosive price movement. The economic calendar is useful in that respect because you can go in and see where these events are likely to form. So I'm looking for days in my son's model where he can go in and engage price when there is a medium or high impact news event. Or if there is a lack of one, he can practice, but he shouldn't be engaging with his normal risk percentage. Okay, so the first element is time. So at 8:30 in the morning, that's when a news embargo lifts. That's the first element of time that I taught you with this model. The second one is 9:30. Okay, that's right here. The first here. At midnight New York local time, that opening price is here. Did the market rally above that opening price at 8:30? Yes. Are we bearish? I proved this morning I was expecting lower prices. I preferred lower prices. So that means we're above the opening price at midnight. So my Power 3 concept is you want to be shorting at or above the opening price at midnight in New York local time, if you're trying to capture movement on a daily range on a down day. So that opening price, look what happens. We run up, take out short-term highs here. That's a short-term run on liquidity. Who's going to have stops at that 1 minute? Anybody that would have put a stop loss in on these lower time frames, there's traders that are doing that all the time. The algorithm is not aware of how much volume rests above or below a high or low that's penetrated. It has no understanding of that. It doesn't need it. For folks that are perplexed by that statement, and I've said it several times in the past, you ever play a video game? How about Pac-Man? I'm a child of the 70s. I was born in 1972, August 8th, 7:11 p.m. See that? 7-11. Lucky 7-11. I came in the world with some luck, didn't I? So when you're looking at a game like Pac-Man, okay, what keeps Pac-Man inside the boundaries of those lines that make up the maze that it runs around and collects and eats those dots until it gets to a power dot or chased down and killed by the ghosts? The program language keeps him limited. The playboard or game maze has limitations. Those limitations are programmed as such. Every video game today, they have a map. Okay, Fortnite, Call of Duty, Battlefield, all that genre of video game creation, all of those maps or territories that the player gets to enjoy and explore, they have limitations. Okay. The daily range has those limitations programmed into it as well, until manual intervention is brought in and those initial boundaries are removed. Okay, so think of price like that. So if you know that we're likely to see that, in terms of like an analogy, we're at 8:30, we're above the opening price at midnight. We ran a short-term high here. The algorithm doesn't care how many orders were above that. It doesn't care. It just has to take out a short-term high. It does. So it's at a premium. It took out buy side. So what is it likely to do now? Because we're in a bearish day and we're above the opening price and it's at 8:30. Reprice for what? Sell side. Where's sell side? This level down here. 4101. Or what? 4100 big figure. 4100 level. So there's liquidity resting below that. What kind of liquidity? If market's price is here and sell side is here, it's old lows, there's sell side below that. So market price is here, relative equal lows in the past is this level here. Go back in the beginning of the video. Okay, you'll understand what that level is then. That liquidity is sell side. We're at a premium here. This would be a discount because market price is here or here. Anything below it is what? Discount. So the algorithm goes from buy side liquidity at 8:30 on a bearish day above the opening price. Wait for the market to trade lower. It does. Short-term low. See that? Swing low. Trades through it. Creates a fair value gap. Rally back up to it. Sell short with the expectation it's going to run to sell side liquidity. This is what I'm teaching my son to do at 8:30. That's all he's trying to capture there. In this move, he may not run all the way to the sell side. He's going to get his 5 points. Once he does, he's stopping. He gets out. And then he watches the move go to the sell side liquidity pool. Why am I telling him to get out at 5 points? Number one, 5 points is very, very easy. I think that is the lowest threshold of points a setup should hopefully yield. If you're trying to do anything less than that, you're doing ultra short-term scalping and the commission costs will kill you. It ain't worth doing. And I think 5 points is an easy threshold. You can do it once in the morning. You can do it once in the afternoon. Even on a really weird, choppy day, you could reasonably pull out 5 points if you have the experience. You don't have that experience yet. So let me put that in your mind right now, because I don't want you thinking, well, I'm going to go out there tomorrow and do what ICT said. I've only been trading for a week, so I think he's really convinced me that I can pull this off. And it's going to be 10 points a day for me, 5 in the morning, 5 in the afternoon. This is going to be cakewalk. I might as well just put in my 2 weeks notice now and tell the boss, pound sand. No. No, don't do that. You're not ready. But if that's a goal for you, start working towards it. So over time, my expectation is that my son will have a better understanding of what he's doing. And those 5 points, he'll have hopefully learned to take a portion off at 5 points and then hold for that liquidity pool to be hit. And because of doing that very thing, he's rewarding himself initially while he's learning. So it engages him. It shows that he can make more money doing this than his job. Okay. That does not mean that you can do more than your job. I'm saying this is my son. He has me as his father. I'm sitting with him. I'm coaching him. I'm telling him what he should be focusing on. I'm questioning why he isn't focusing on other things. So I'm actually like co-piloting him. I'm giving him, visual and audible clues as to what he should be using to navigate price. So don't think for a moment, folks, that he sat down, and did like a couple days of talks with daddy, and now he's out there making 400% gains from his equity low up to where it is now. That is not what took place. Okay. He has the benefit of me sitting with him, talking to him. Okay. Much in the same vein that I did with you all this morning on Twitter, where I said, this is what I'm looking at. These are the levels I'm looking for. If this breaks, I think we're going down to that level. I'm doing that on a minute by minute basis with Caleb. So he's literally driving a car with me talking about every pothole, every potential hazard that's coming. I'm reading the mind of all the drivers around us and telling him what they're going to do before they do it. So it's a totally immersive experience for him.